big moves today, but the biggest moves from a sector perspective have actually been among the year-to-date laggards. So tech, real estate, consumer discretionary, communication services, those are the areas that were most underwater year-to-date. Those are the areas that are bouncing the hardest today. Good afternoon, everybody. Welcome to Townhall Takeaways. Willie Delwich here. Just got done with our weekly town hall. Figured I'd share a couple of the key takeaways from that conversation. It's Thursday afternoon. Markets are responding to what seemed to be a pretty benign CPI inflation report this morning. Everything is green. Stocks are up. Bonds are up. So bond yields are down. Really a great day to be long either stocks or bonds. Lots of day-to-day volatility today. These big swings. It gets really exciting to see that. You think, oh, there's a strength we've been looking for to see that big 3, 4, 5% up move in an index. Not to rain on the parade, but I don't think that's actually what we want to see. In fact, history shows there's a pretty clear inverse relationship over the years, over time, between these number of days that we have with these big swings to the upside and to the downside. Inverse relationship with that volatility and strength, number of days, a percentage of days with more new highs than new lows. That's something we've seen all year this year. The concern is that's more of what we're seeing right now. And so while it's exciting to see these big moves, that's more typical of an environment of weakness than it is sustained strength. And that needs to change if this isn't going to be an environment like we had in 2008 and 1974, where lots of volatility but no strength. And so far, from what I've seen, the day is not over. I don't want to call a close of the market, but again today, more new lows than new highs. It's been now 58, 50, I think 59 days in a row now that will be the case. That's the longest stretch since 2008. That's not a sign of strength. It's a sign of volatility. So the first takeaway, yeah, it feels good when the market's up big, but that's typically an environment where you see volatility, not typical of an environment where you see sustained strength. So we really want to look for that sustained strength, but there's still things that we can do while we're looking for that sustained strength. We want to see opportunities. We want to see, within the equity market, within, across the various asset classes, to see if there's opportunities that we can lean into. One of the claims, one of the things I've heard this year is, well, stocks are down so much, valuations well off their highs, stocks must be getting cheap. And yeah, if you look at forward PE ratios, stocks of the S&P 500 has moved from basically its most expensive ever to approaching, not getting there, approaching its long-term average. However, if you contrast that or compare that with what's happening from a bond perspective, and rather than thinking about PE ratios for the S&P 500, start to think about an earnings yield, so an inverse of the PE ratio. You can, if you look it up, it's easy to see. You can see that the Treasury yield is moving sharply higher. Earnings yield is only moving slightly higher, and on a relative basis, the spread there, it actually suggests that bonds are cheaper than stocks at this point. Based on where they've been over the past 30 plus years, on average, you have a spread, an earnings spread to Treasury, or earnings yield to Treasury yield spread of about 3 percentage points. Right now, it's approaching 0, less than 1 at this point. So yes, stocks have gotten cheaper this year, but that's because bond yields are up so much. And actually, from a relative perspective, history suggests that bonds might be cheaper than stocks. Look at a trend between stocks and bonds hold the advantage from a long-term price trend ratio. So if there's an opportunity to do something right now while we're waiting for that sustained strength, it's maybe to look at bonds, which are now offering a yield of 4% on the short end versus 0% earlier this year, rather than saying, well, stocks are only now approaching their long-term average from a forward PE perspective. So that's second takeaway. I don't think that bonds or stocks are cheap now just because PE ratios have come down so much relative to bonds are actually more expensive than they were at the beginning of the year. So then from a sector perspective, what do we want to do? What do we want to think about from a sector perspective? And again, big moves today, but the biggest moves from a sector perspective have actually been among the year-to-date laggards. So tech, real estate, consumer discretionary, communication services, those are the areas that were most underwater year-to-date. Those are the areas that are bouncing the hardest today. What I really want to focus on from a sector perspective is whether or not they're above or below their August high. And right now, energy is the only sector that is above its August high. There's a couple that are close. Industrials are not too far away. Healthcare is not too far away. Financials are not too far away. And depending on how the market closes today, maybe we will get there. But if we're not above our August highs, yeah, we can look at relative strength in terms of where we want to be looking. But in terms of what we want to be doing, it's not time to pull that trigger just yet. So relative strength, relative leadership is great. But in terms of actually increasing exposure somewhere, we want to see absolute strength. And I think from a sector perspective, that means getting above those August highs. And so far, it's only energy. And probably by the end of today, we'll have tech and real estate above their June lows. So that's a sign of improvement. But it's not the sort of strength that we want to see. We don't want to see less bad at this point. We really want to see things improving and actually turning good. So that's the third takeaway. We want to be interested above the August highs for the sectors, for the markets, for around the world. That's where we're really looking for evidence of not just relative leadership, but absolute strength. So those are the takeaways. Appreciate you joining. We'll do this again next week, Thursday afternoons, Townhall Takeaways. I'm Willie Delwich. Thanks for listening.